Thank you for joining iMeet. When you hear the tone, you will be the 37th person to join the meeting. The meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with the Tuesday Tech Talk, and we're going to quickly review the last volatile days, to say the least. Try to figure out what we want to do over the next few days, see where the market might be going. We're going to look at a lot of different charts, not so much individual stocks and sectors, but more of the broader market. If this is your first time here, we usually talk about 20, 25 minutes, and we try to open it up for questions from you. You can ask about individual stocks or industries or targets or anything that's on your mind, and we'll see if we can answer them there. So let's just jump right in, because it's been, after a year and a half or so of no volatility, we've certainly had a lot of it here in the last couple of days. So we're going to, some of you may be a little anxious, and we're going to see what we can talk a little bit here and calm you down and decide what we're going to do. So let's start with the Dow Jones. We're going to look at some longer-term charts on this stuff too, but the first thing we're going to look at here is just a 6-month chart. The CTI finished last week at bullish +7, slips down to a +5 this week. It's still bullish on the broader market. That doesn't mean the market's getting weaker just because the CTI is going down. It just means that the cycle is coming to a short-term change soon. With this pullback here, instead of in about 3 weeks, I may have to adjust the cycles a little bit, but I think we're still okay for right now. Okay, the momentum index fell to a -6 last week. That meant that a lot of the other indexes fell more than the Dow Jones, which makes sense. They've been underperforming the Dow going forward a little bit here the last couple of months. Sentiment actually improved a little bit. Last Friday, we'd gone to a -1, up 2 notches from a -3, meaning that some of the bullishness had come off of some of the investors, which was a decent sign. Still has a ways to go, because sentiment was almost where it was back in 1986 and 87. So I put some downside targets in the indexes in the market letter last Friday. I thought we could probably test 25,000 for the Dow, and I think 26 or 2710, 2715 on the S&P 500. Well, we took those out on Monday, so we'll be coming up with some more targets today, which I think possibly we may have already hit. That's a good sign. You can see on this first chart today's actions on the Dow. Basically, what we did, we came down here to the 100-day moving average. Now, in yesterday's or on Friday's letter, we talked a little bit about the Russell 2000 was the first index to go down and test that 100-day moving average. The transports bounced off of it. They got a little bit weaker, but today we have yesterday the Dow Jones hit the 100-day, and today we fell below it before bouncing back up. Now we're positive right now by about 32 points. You can see the 14-day RSI broke below that 40 level, which bears watching. We'll see if that comes back up. We're still above 20 on the 30-day stochastic, so we'll watch these things a little bit in here. It's not a pretty chart, to say the least, but I think we certainly are in the phases of bottoming. The markets have corrected now about 10%, and that's kind of that's a little bit more than what I thought we would do. But we can live with that. Especially, you saw this morning how fast people covered. We went from -567 points at the open to where we were up about 400 points, I think, in the Dow within about the first 45 minutes or so. Okay, we had breadth has been horrible. It was horrible last week and continues to be horrible. It's not so bad today. We're about 300 units on the AD line with the Dow today, but you see this thing breaking down. That's just weak. It's a broad-based sell-off. If you're holding 15 stocks in your portfolio or 10 of them, probably all 10 of them are down here over the last week and a half. So this is going to continue lower from here. Also, you'll see a spike over here in the number of new 52-week highs versus lows. Now, on the NYSE, in fact, we mentioned this last week. Someone talked about the operating companies, and they were wondering why we had so very few lows on the NYSE. A lot of the NYSE has a lot of interest rate sensitive, preferred stocks, that type of thing, bond funds. That as the rates ticked up last Tuesday when we talked, I think rates were at 261, and they ended up last week at 285. So a pretty good move, which we'll talk about in there. That caused a lot of this up here is the interest sensitive things that have spiked up. So we want to, we'll watch that a little bit. Probably take away those, and you're probably down here around 200. All right, now I want to look at the longer term charts too. This is a 2-year chart on the Dow Jones. I put in a long-term trend line going up like this, or not even to that. If the long-term trend line kind of coincides with the what would be the 200-day moving average, I think that would be, if we get some kind of more bad news, that would it's possible that would be the ultimate downside to this thing. But I don't think you're going to hit go any more than this one. This is a 38.2% Fibonacci retracement. This is yet some pretty good support and resistance at that level, which is basically the end of November, 1st of December level. So this parabolic move that we had, we've pretty much wiped that out. We'll talk a little bit more about that too. But I'm not sure if things really pick up here over the next day or two, where something else hits the market. I would jump in, with guns blazing down here at this level on the trend line, and also where it is, like I say, it'd be the 200-day moving average. A break below that would mean that we're probably going to a bear market, and I just don't see it. We still have some work to go to the downside, maybe on some of these stochastics, but when you look at the weekly, you can see the strength of the broader market is still a little bit full. We're not even down to the 50% level on the 14-day RSI on the weekly chart. So again, I think that worst case scenario in here, we're around 23,150 or something. We hit 23,778 this morning. So if you didn't buy anything this morning, I'd keep that level on my wish list and buy at least a half a position at that level. If it happens to break, and then you'll have some more money to go down for if it would go to the 50% retracement level, which I think is real unlikely. All right, here's the S&P 500. This is a six-month chart. Here's our trend line, intermediate term trend line. We actually broke that. We broke the 100-day moving average. We've bounced right back above that now. Again, if you remember last week, we talked about at this level right here. This was the most overbought the S&P 500 had been in like 20 years. So we're way overdue for a pullback. We certainly got it. Now we've gone from way overbought to an oversold level. The S&P oscillator that's included in your Market Edge subscription, which can be found on the home page on the Market Edge 2.0, hit 6.8% yesterday. Last time it hit that, I believe, was in February 2016 when they had those big dips down in January and February. So you hear Kramer talk about that oscillator on his show a lot. That's something that has been in existence for quite a while. When it goes below 5, usually represents a pretty good time to get back in the market. That minus 6.8, maybe it hits minus 7. That's telling you that I think we probably have a chance. We came down here to hit 30 and bounced back up on the 14-day RSI. We'll see if that gets above 40. Here's the NASDAQ. Let's see here on the NASDAQ. Okay, the NASDAQ. Again, we came right down to the 100-day moving average. Amazing how these things work. Now, here's the intermediate term trend line. We broke that yesterday, which kind of coincided with the 50-day. We bounced strongly off of this 100-day moving average. This is the kind of thing you want to see. The reason why they do that is because these averages are watched by traders, hedge funds, that type of thing, and it represents a good area for them to buy. If we get a retest of that, we get another pullback in this market, that would be a place that where you want to start to put some money to work. If we can get down to there again and bounce off of it, and we may not even get down there again. I don't know if you'd call it a selling climax, because I'm not sure the volume was there on it, which we'll also talk about later. But if you just would pull back, and you need some back and forth filling of this move over the next few days to consolidate some of the losses and everything like that before we can start to move higher. But that certainly represents a big area of support right now And I would, if you get another day to buy something like that, I would buy at least a half a position on that. Okay, as far as breadth on the NASDAQ, wait a minute here. I got my charts mixed up a little bit. This is this should have been the one before. This is the S&P 500, the weekly chart. And again, you can see we came almost down to this 38.2% retracement. Very close on it this morning. Not quite yet. Generally, if you break that, which would also be the trend line where it comes in, you may get a chance to go down to that 50% level. I think that's unlikely. You know, we've almost retraced this whole move from December and January. But to me, I think that this trend line and that 38.2% retracement is probably going to hold on this go around. We'll see some back and forth filling in here. Okay, we just looked at the NASDAQ. Okay, here's the NASDAQ AD line. We lost about 4,000 units last week. You lost about 2,300 yesterday. So it's weak. I mean, it's broad-based selling. Investors were throwing in the towel. Again, you can look at these levels for support. We're going to lose about 400 or 500 units today, so we're going to be right down to around here today. Here's the 52-week new highs and lows. This is a little bit more indicative of what's going on because you don't have the preferred stocks on here. So you had about 200 new lows, new highs. You only had about 20-something yesterday. It's a weak market. This is kind of what you'd expect, but it's not, I'm not throwing in the towel or anything like that thing. I'm just on that. Okay, here's the NASDAQ longer term. Again, we have this long-term trend line. Haven't even tested that yet. It's a little bit above the 38.2 retracement, which is also just above the 200-day moving average. I don't think you'll get down to this level. Again, you can see on a weekly chart, the indicators are a little bit better, much better off than they were on the daily. We're not even down to the 50 mark on the 14-day RSI. So again, we're going to watch today's level, which of course on the weekly chart you can't tell, but we want to keep it on this level, which is around 66, I think, on 6,600 on the NASDAQ. That's probably where we would give the trend lines up here around 6,700. So that would be the first battle we see. The 38.2 is down here around the 6,600. Okay, next one we have here is the Russell 2000. I told you last week or yesterday we broke below that 100-day moving average, which is negative. But look where we came down to this morning. We came right down to the 200-day moving average, and it bounced off of that. That's a nice sign of a bottoming on that. We want to see the Russell, which is still down a little bit right in here, 1485, which puts it right about where it is. That's the 50% retracement of this whole move from last year's election. No, this is from the August, the summer when we had a little bit of a run-up from there. So we've already retraced 50% of that is where we're sitting right now. We came down and tested that 200-day moving average. That should provide a support level for that. If you look at the longer term, the 2-year chart, this goes back to the election. All of these are. I took the Fibonacci from the election and up, moved it up from there. Okay, we briefly broke this the long-term trend line on the Russell 2000. It actually came down to the pivot point, and we're right at that pivot point right now. The pivot point here is 1475, and we're actually at 1485, so we're just a little bit above it at this stage. And on the longer term, again, you can see we're right about that 50 level on the RSI, 14-day RSI. So, we're almost right at that 200-day moving average. We may get down to test that again, but those are the levels that you want to keep an eye on. But I think if we get some back and forth trading, that is where we're going to consolidate in this area right here before we can actually move a little bit higher. But that pivot point, hopefully it holds over here the next day or two. You may get some retests of that 200-day. We'll see. All right. I want to talk a little bit about last week. We talked about don't be fooled by this bull market and all the the little danger signs that we saw popping up. What we talked about last week, why are we making money in this bull market? Why does this thing keep going up every day? So we're going to talk a little bit about those regulations and see what changed. And number one, we look at here, the tax cuts. Okay, that's what gave us this parabolic move in December. That's still in place, so nothing there that's changed. Deregulation, still there. Infrastructure spending, still there. Synchronized global economic recovery, it's still on. Expanding earnings, we have great earnings, and they've actually bumped up the rest of it going forward for the rest of the year. I added one. There's another reason why you can like the market in here. Reasonable valuations. Last week, at this time, the market, the S&P 500 was trading at about 19.5 times earnings. That was above the 10-year PE for the S&P 500, and it was stretched, and it was a little bit that the stocks weren't cheap at that level. All right, since this 10% correction, okay, now we're trading at a more realistic forward 16 times earnings, which is not totally out of line with going over that back over the last 10 years. I was meant to look for, I think over the last 10 years, 15 to 16 is where has represented a pretty good valuation for stocks going. So we actually added with this 10% correction another reason to own stocks, not to sell. All right, and we also talked last week about what could go wrong in this thing. Okay, a spike in inflation. Okay, well, we had a little bit of move in that. This was important. This is the number one thing that caused this to start the sell-off last week. Okay, we got a jobs report that showed wage inflation. All right, that was a red flag, because if we get that, that means if we get wage inflation, which shows inflation, perhaps the big thing with traders right now is the Federal Reserve behind the eight ball. They're going to have to start talking with instead of going up in March a quarter point, are they going to start talking, well, we're going to go a half a point, and then we may have to go another half point in June or something. Okay, the market can weather quarter percent steps up. A gradual stepping or increase of rates, it can handle that without any problem. What makes traders nervous is when you have a big jump or a spike in rates. Okay, about 2.6 to 2.85 is a big jump in the 10-year Treasury yield. That's caused a lot of this thing to cause a lot of this sell-off, because again, if we're behind the eight ball with the Fed, then they're going to have to start talking about raising rates, and that could maybe get us a little bit, cause this thing to go back and forth a little bit. The market isn't cheap. Okay, we got rid of that one, so that's a good sign. Okay, like I say, we went from 19.4, 19.5 times earnings down to 16, so that's good. All right, global central banks need to coordinate rate hikes. They're still going to do that. That's fine. No war. Okay, volatility. We talked about that last week. That could cause some problems for the market. Why? Because when you see volatility spike up like this, we went from 9 about 2 weeks ago to 37 yesterday. That volatility, how is mom and pop going to handle this volatility? They come back into the market. First thing they know is, holy crap, we got a 10% correction. Are they going to jump out? It's no different than last time during the financial crisis. I need to get out of here. I'm not going to the market again. Is that going to happen? Possibly. One of the things that we've talked about over the last year was this passive investing, and how people are going to react to that. Passive investing is where everybody just stocks everything into an index fund, so they all own the same stocks. That has helped the market to go higher than it normally would, because of all the stocks that are in that in the S&P 500, the Boeings and all that causing it to go up higher than what it normally would. Okay, well, we get that volatility and they start jumping out and they start selling the same stocks because they have to, because I want to liquidate my fund, get me out of this thing. That's going to cause the selling to go down more than it normally would if there wasn't as much passive investing. So we'll have to. It's too early to tell on that, but I'm sure some people are going, whoa, trying to figure what to do. Higher yields, well, okay, well, we got higher yields, but I don't think, as long as we stay below 3%, I think the market can handle that. We're at 2.75 now, so we've backed off 10 points on the 10-year. What the market has to do with the higher yields, whether we get up to 2.9, 2.95, maybe 3, maybe 3.1, is it has to adjust to the level that where the institutions say, okay, you know what, I can take 10% of my money out and get 3.5% on this thing, I'm going to do that. So there's a level of where certain funds are going to come out when you get to a certain level of on yields. I think above 3%, 3.25 at tops, that would 3.25 definitely would cause this thing to maybe have another leg down. You know, maybe by that time we're back up near the old highs and it comes back down again. But the market will have to adjust where yields are going to be, and that doesn't happen overnight. That can take a little bit of time. Okay, Trump's erratic behavior, I think we're stuck with that no matter what. Trade war, China and NAFTA, I don't think that's going to happen. But so we had a few things get better on the pullback. We had a few things that could have gone wrong, have maybe gone away. All right. Now, what happens when rates rise? I hope that doesn't bore you, but I just want to throw some of this stuff in. Okay, this is by Sam Stovall. He's S&P chief analyst over there, chief market technician, and he's done some studies on this. Since 1946, we've had 16 periods of rising rates. We're now in number 17 in here. During those periods, we've had 6 pullbacks, which was a pullback. We're going to have 5 to 10%. That's just what we just had. Actually, 10% sometimes called as a correction. We've had 4 corrections once they started raising rates. That was a 10 to 20%, and threw us also into 3 bear markets, which is 20% or more. The bear markets each time, again, it wasn't just the fact that we were raising rates. It was the fact it was a projection of the rates and the intensity level of the rates, where we weren't just moving up gradually. It was where we were moving, quickly and quicker than the market anticipated. All right, so that meant once we're in this cycle, at some point when we started raising rates, we had an 88% chance of the market going down. Okay, we finally got that, and we're right where we should be normally, and we're right in the middle of what's happened over the last 46 years of what has typically gone on when the markets when rates start to move higher. Okay, the length of the pullback or correction has averaged about 6 months. That's within, after they start raising hikes. Now, we were such a low level, the market didn't respond at all once, we went from a quarter point to a half point to 3/4 point. Now we're at a point where, these even a little quarter point is going to make it just waver a little bit. Now, on average, after we started raising rates where it mattered, 6 months later, the market was up 1.3% from where we started. So if we say this last thing in December, we were at about 24,000. That would put us up, pushing up towards the 25,000 here in the next couple of months. And Bloomberg, they said since 1952, on average, stocks have risen about 4.2% in the first 6 months after the rate increase. That's going out after the 6 months, I believe, and then we start to rise 4.2 for that year. And the S&P has risen 5.8% in the following 6 months after that. So, again, you have to remember that the reason we're raising rates is because the economy is better. Now, if they're raising because inflation goes from 2% to 5%, that's not raising rates because the economy is better. That's when we got a real problem. But they are raising because the economy is getting better, and that's what we want to don't lose that focus of what's happening with this thing. So, what I believe is going to happen here to summarize this thing. Okay, let me go over this real quick. I wanted to throw this thing in here because I don't think we had this today. It came very close. You hear traders talking about a selling climax. What that is after the market starts to go down, you have an index or a stock opens up sharply lower like we did today, reverses course, and closes higher. Now, we had that. The only thing that's lacking so far today, I'll tell you what, though, we are having a good volume day. But usually volume will double or triple on the daily volume when you have that. If you look at a candlestick pattern, you'll have an up top, and you'll have this long fuse or rat tail coming down. That shows you where the selling climax took place. Now, what traders are going to look for, if, like, say today we had that 567-point down day, let's say we end up 105 or 100, maybe 200 points. Okay, we want to make sure the next trading day is another up day. The traders will use that for confirmation that a bottom could be in. The high volume, what that indicates to us is that indicates a change in psychology. The investors are all of a sudden, you know what? Okay, everybody's out. It's time for me to get back in. So that's something we want to watch to see if today may qualify as that. You'll probably hear about that later on today at after 4 o'clock. You'll hear some people talking about that, and it's whether we classify that as that or not, it's close. So just to summarize things real quick, if you want to get your questions ready, go ahead and start putting them in. Over the last few years, almost every pullback we've had, ended in a V-shaped recovery. The last few days, the selling's been very intense. We corrected about 10%, which is not, an abnormal correction by any means in a bull market. All right, now the different indexes are where they were about the 1st of December. So we've given back that parabolic move that was, a little bit too much, sentiment and everything had gotten way too bullish, and but that was brought on by the irrational exuberance maybe brought on by the tax cuts and the expectations of big fourth quarter earnings. Okay, sentiment had gotten to a level that was last seen in 1987. We talked about that a little bit. It was a big red flag. My best guess is that there's a 10% correction we're going to see. We're going to see a lot of back and forth swings in the market here. We're going to consolidate where the traders and all think the market should be after with the rates moving up a little bit like that. What should we do? I believe that we'll be in a trading range. Probably it could be for a week or two. It could be for a couple of weeks. The trading range is kind of it's kind of tricky for investors, especially on a pullback. Number one, a lot of people will get whipsawed. The reason being because if you'll see the market starting to run up towards the old highs, and you think, I missed the pullback. I need to get in, and just as they get in, all of a sudden the market starts to sell off again. It goes back down and tests the bottom. It gets down towards the bottom. Investors are convinced that we got further more to go to the downside. I'm getting out. They get out there, and the market turns around and goes right back up. So, over the next few weeks, like I told you last week, hopefully we're all in this together, and we'll talk about this weekly about what kind of action we should have. But I don't think we're going into a bear market. The reasons why the stock has been going up are still in place. I think you need to have a plan where you have a list of stocks that you've wanted to own. You want to make sure those stocks are still outperforming the market. Last week we talked about selling stocks that are underperforming the market. You should go ahead and get rid of those in a move that's gone parabolic like this, and they're not doing anything. Okay, so what we're going to look at right now is when you go into your list of stocks, look at that second opinion, look at the 50-day relative strength, make sure you're at least above 1.02 or higher. I'd maybe wait a few days, let that indicator catch up. And the point of this is, if we go into a trading range, you're going to have the opportunity to adjust your portfolio, add to a couple good, strong stocks. And like I said, I think we can navigate this thing together on our Tuesday Tech Talks, which we'll try to, we come in here with questions. You'll help me, I'll help you, and we'll just kind of try to see what's going on with the market, and hopefully identify, more heads we have, the better. We'll try to identify a trading range. We'll see if the volume, or we're seeing any negative divergence where the market's going up that could lead, that possibly would be telling us that we're, the market's going to head lower again, or where we're seeing bullish divergence as the market comes down to test these lows. So, like I say, hopefully I don't think we're by any means going into a bear market. I would use, like I say, we're range bound. Buy some stocks at the bottom end of this, and maybe clear out of some positions that will go up. One other thing to keep in mind, if we start to move higher and we don't, let's say in about 4 or 5 months, and we hit a high of maybe 500, 600 points less than where we did before, and we start to roll over again, when you have a lower high on a big longer term chart, that's another big red flag. But we have time to talk about that, because that's something that would happen over the next few weeks. I had a couple questions come in. I see them over here. Somebody wanted to know about REITs. They saw an article in Saving Alpha. This guy said the lower they go, the more he's buying. Let him go ahead and buy all he wants. The REITs are still going lower in a rising interest rate environment. We talked a little bit the last couple of weeks. If you want to have some income from REITs, you're not buying the REIT that has lousy properties but pays out 7%. You may want to look at some REITs that is looking to be aggressively buying properties that are going to increase in value, that are only paying like 3.5%, 4%. They're not going to get whacked by rising rates, and you're buying something that's going to appreciate in value. So if you just to buy something that you go, oh boy, here's a 7.5% yield on that trade at $25, well, you'll probably be selling it in 6 months at $21, and whatever you made on your dividends, you're going to lose. So let me look here real quick at a couple questions that have come in. Is it okay to start a position in Amazon? I would say so, but real quick, Jeff Bezos the next Warren Buffett? I don't know about that. Which sectors, industries will come back up first? Let me address that one first, because as you know, I run a little bit of a sector portfolio, and out of the 10 sectors that I have in there right now, only one of them is down. This week I added steel, SLX, which I bought yesterday, and it's actually over the 2 days, it's actually up almost 0.25%. XME, I bought the miners 2 weeks ago, and I'm down about 8% in that thing, but we're up 2% today. BJK, which is a gaming sector industry, that is about flat. It's up about 1% since went in. RTH, I still like the retail. It's up 1% today. IAI, which is insurance groups, that's still up today a little bit. That still looks good. Oil to me still looks good. Until we break 62, I'm holding on to my oil. PXI, which is let's see, PXI is the that's also an energy sector. Then we have the IYG, which is a global financial. I think that was a good one to own, because you're up. You want to have exposure to European banks and that kind of stuff. They're about 1.5 years, 2 years behind us. IEO, which is oil and gas exploration, and FDN, which is the internet. All of those are up today except for the BJK. It's off a quarter. So that's what I'm holding in a portfolio of those sectors right now. Opinions on preferred in this environment. John, preferred stocks are, again, until the rates stop going up, even if they stop at 3%, what you have to find out is what level on the preferreds our investors or the institutional traders are going to say, I can own that. I'm not going to lose my butt on the principal. And if that doesn't happen right away, they have to be sure that the rates are pegged at 3%. So pegged at 3%, maybe a preferred paying 8% is good. Maybe if it pays 9% might be a little bit risky, and they won't hold on to that. If it's paying 6%, they might say, this isn't enough to keep me in this preferred. I'm going to go ahead and get out of that. Rates are up. I want to see what comes down the pike, and I don't want to lose any principal on that. Tech sector on the SOX. The SOX is having a pretty good bounce back today. It was up. We're up 1.5%. Remember long term what we like. The industrials, the technology, biotechs. Biotechs have had a little rough time today. They're down about 4% in here, or 0.4% today. The sectors that we've talked about where we want to be in is still where we want to go on these dips. Okay, crude oil. Do I still like that? I like oil as long as we stay above that 62. And again, if we start to break 62 and then go down and challenge that 60, that means you may be having too much fracking coming on shore. As long as we stay above 60, 62, the frackers are going to come on. That's going to keep the upside somewhat limited. But I still think if we can start to move back here and the economic data doesn't get too strong. Remember, good news is bad news right now as far as the economic data goes. We want to have a couple misses instead of, like yesterday we had the ISM non-manufacturing index come in at more than a 20-year high. We don't want that anymore. we want to have this thing, we want to have it come in where it's bullish, but we were looking for 50. We only got 46. Well, but that's still pretty good. That puts the Federal Reserve on hold. So, good news is bad news. You don't want all bad news, but you want the stuff to come in and maybe be a little bit shy on here. What do you think of Exxon for income to buy in stages? I wouldn't be a buyer of Exxon right in here. I think there's other oil stocks you could own that would go. In fact, I saw several downgrades on Exxon in here, like an $80 price target. They have too much waste going on right now. I think that if you're going to, for a natural oil play, there's others that we can look at. We looked at a few weeks ago, but I'll see if I can come up with something maybe next week. What do you think of trading DDM? Let's see here. DDM Ultra Dow. You know what? These leveraged ETFs right now. I would wait a little bit, and we have a list of them we've gone over the last couple of years. We're actually up about 13% of this last call. I'm sure we've given back all of that, but let's give this thing a few more days. If you see this thing come down again and test the levels where we were today, I would buy the leveraged ETFs. You can get in there. Make sure you don't just buy the open, because a lot of times if you buy an open on some of these ETFs, they haven't adjusted the level to where it should be. So if the market went down 400 and the ETF went from 20 to 22, that may not be where the prices should have been. Maybe it should have been 30 or 35 or something. So I would wait until we get at least a retest of one of these bottom levels or one of the moving averages before I would look to buy a leverage thing. Because again, I'm not so sure that we're going to, this is going to be a V recovery this time, because we're at the point where we have to see, see a little bit slowing of the economic data, and until we see that, you're still looking at the possibility of, boom, we're going to go to 3%. Boom, we're going to go to 3.25%, maybe 3, a little more than that. So we're on hold, and the market's a little bit on hold. That's why I say we're going to stay in a trading range for a while until we can see where if the economic data will, level off here a little bit, and we're not sitting here blowing away all the estimates every week. So the Fed all of a sudden goes, we gotta get in front of this train and slow it down. Okay, I don't see any more questions coming in. As usual, I talked a little bit too long. Listen, I appreciate you taking time out of your busy day to join me with this. I really hope you got something out of this. I want us to keep going on here while this market's doing what it's doing, and we'll relook at things on next Tuesday, see where we are, see if we got some more bottoming patterns coming in, and go from there. So thanks a lot. This thing should be back up on the website in probably about 2 hours or so. All right, see you next week, and have a good week.